Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Happy Monday, everybody. In recent days, Spanish football organization La Liga terminated a media broadcasting deal with Chinese sports marketing company Super Sports Media, a wholly owned subsidiary of Wuhan DDMC Culture Co., due to missed payments. La Liga said that the Chinese company Super Sports failed to pay a broadcasting rights fee of 45 million euros due the 20th of January, and that it was seeking 105 million euros in compensation. Now, why is this broken contract with a Spanish football organization important? Well, as analysts point out, Wuhan DDMC is yet another Chinese enterprise losing broadcasting rights to top international sports events due to financial troubles after, as one analyst at Caixin put it, a frenzy of rights buying several years ago. Quote, Wuhan DDMC in 2019 inked a 6-season deal with La Liga for full media broadcasting rights in China covering the 2019-2020 season to the 2024-2025 season. The games contributed about 30% of Wuhan DDMC's sports-related revenues in 2021, totaling 1.3 billion yuan, $194 million. Losing the rights to show La Liga games is another blow to Wuhan DDMC, which has suffered business declines due to pandemic disruptions. End quote. By the way, it goes without saying, I don't speak Spanish, please forgive my pronunciation. The analysts remind us that in January, a UK High Court ruled in favour of England's Premier League in its demand for 213 million from Chinese broadcaster PP Live Sports International Limited in disputed payments. This dispute with Wuhan DDMC will likely not be the last that we will see this year. Okay, next up, the jump in crude oil prices that economies around the world have been struggling to deal with in recent months has been a windfall gain of types for developing oil producers which have entered oil for debt repayment agreements with the People's Republic of China. The People's Republic of China is still hungry for energy. Angola, the second largest oil producer in sub-Saharan Africa, is one example. According to data from the country's finance ministry, so let's take it with a grain of salt, Angola's oil revenue jumped from 1.4 billion in April to 2.1 billion in May. Falling oil prices in the middle of the last decade caused the African country to fall into recession. Then in 2020, China agreed to allow it to defer debt payments until the end of the second quarter of next year due to the pandemic blow-up at the time. Debt owed to Chinese creditors was sitting at about $22 billion in 2020. However, with this increase in oil revenue, Angola has resumed principal repayments of Chinese debt in the first quarter of this year, 18 months before the scheduled end of the debt repayment freeze. According to REDD intelligence calculations, debt owed to China decreased by $351 million in the first quarter of this year to $21.4 billion. Of course, debt repayments with oil shipments is a risky double-edged sword, but for now, the higher oil costs are helping reduce Angola's debt exposure to Chinese creditors. Next, and speaking of debt, the housing crisis. We have seen an increasing number of local governments ease restrictions on the demand side in recent months to pump up the housing sector. However, these efforts have had little to no effect in arresting the plunge in housing sales that we have seen this year to date. Now, some regulatory easing is beginning to worry analysts who warn that they may unnecessarily increase financial systemic risk. One example, a branch of Huaxia Bank Co. Limited in Wenzhou, a wealthy trade-focused coastal city in East China's Zhejiang province, will allow some homebuyers deferred payment of principal on their mortgage in the first 3 years, with principal payments kicking in the 4th year. The policy applies to local residents buying their first homes with a minimum mortgage term of 10 years, as well as to second home buyers who have paid off their first home mortgage. The city of Wenzhou has just over 9 million people. However, analysts have warned that it is unwise to allow households, which are already historically heavily over-leveraged by Chinese standards and which have not been tested by recession for at least a generation, to take on more borrowing for which the weight of repayments is deferred for several years. In short, the easing creates credit risks. Zhang Dawei, chief analyst at a real estate services provider, expressed online that this new loan offer will end up costing borrowers more than a traditional loan. Chen Jian, founder of fintech firm Xinfeng Technology, in an online opinion piece, expressed that in the fourth year homebuyers will see a massive jump in payments, about 45% more money than the previous year. And of course, we cannot assume that interest rates will stay low in the current environment. Indeed, Chen compares these mortgages rolled out by Wenzhou to the subprime mortgages extended by US lenders from 2004 through 2006, which also allowed homebuyers to pay only interest in the first few years in an effort to get more people buying homes. Okay, finally, while we're on the economy, the long-term trend of the decline in retail investor dominance in China's stock market appears to be accelerating in recent months. In 2021, retail investors' equity trading volume was sitting at about 70% of total market value. Indeed, last year the value dropped below 70% for the first time ever. For comparisons, in the United States, retail investors' equity trading volume is only about 10%. In the US, the market is dominated by institutional investors. Since the inception of the Shanghai and Shenzhen stock exchanges in the 1990s, China's stock market has long been dominated by individual investors. Analysts have long observed that individual investors typically have shorter holding periods, which can contribute to high levels of turnover and market volatility. But this is all changing. At a press conference late last week, Vice Chairman of the China Securities Regulatory Commission expressed that retail investors' dominance is continuing to shrink as institutional investors grow more active and, quote, individual players embrace concepts including value, long-term and rational investing, end quote. According to the vice chairman, total assets of securities and futures companies increased 5.5 times in the past decade, and assets under management by public equity funds have seen an 8-fold increase in the past 10 years. There are more than 200 million investors in the Chinese stock market. Hey guys, if you appreciate what I'm trying to do with this channel, China Update, and you'd like to help keep it financially sustainable, Patreon, buy me a coffee, which is great if you just want to give a one-off tip, or crypto links are in the description below. It's always a huge help as well if you enjoyed the video to like and share. As always, thank you so much everybody for the ongoing support. Yesterday, Sunday, on the first day of the 3-day G7 meeting in Germany, US President Joe Biden announced plans to raise $600 billion by 2027 in private and public funds to finance needed infrastructure in developing countries in order to counter China's older multi-trillion-dollar Belt and Road project. Observers have pointed out that the initiative, the Partnership for Global Infrastructure and Investment, appears to simply be a repackaging of the somewhat underwhelming Build Back Better World Plan announced at the 2021 G7 meeting 12 months ago. However, this new initiative looks to be more attractive than last year's plan. In his speech, Biden expressed, quote, "I want to be clear, this isn't aid or charity. It's an investment that will deliver results for everybody." End quote. In a statement from the White House soon after President Biden's speech, the U.S. administration expressed that through grants, federal financing, and leveraging private sector investments focused on clean energy, communications technology, health systems, and other areas, the U.S. would provide $200 billion for the initiative over the next 5 years. European Commission President Ursula von der Leyen, speaking at the same event, expressed that Europe will mobilize €300 billion for the initiative over the same period. In comparison, China's Belt and Road Initiative involves more funds committed and is focused more on infrastructure investment. There are typically less strings attached to Chinese loans too, which are particularly attractive to political and economic elites in target developing countries. Even officials at the G7 meeting admitted that the Belt and Road Initiative has been influential and has a head start over these G7 efforts. Developing countries have been quick to take advantage of the credit for domestic projects too, not just in Southeast Asia and Africa, but in America's own backyard. Quote, "While there is no official data on the total amount of investments made to date, in Latin America alone, for instance, Beijing has sharply increased spending in infrastructure projects such that China-Latin America trade exceeded $400 billion in 2021, compared to $295 billion for the US. Meanwhile, in a thinly veiled shot at China, Japanese Prime Minister Kishida called on G7 leaders to show a united front to prevent other countries from drawing the quote-unquote wrong lessons from Russia's war on Ukraine. The Japanese leader is reported as expressing in private talks, quote, "We have seen attempts to change the status quo by force continuing and increasing in the Indo-Pacific." End quote. A wary Japan has in recent years been increasingly willing to move away from its traditional diplomatic practice of soft, vague language to more clear statements of concern regarding PRC intentions in East Asia. Japan's ruling Liberal Democratic Party has asked Kishida's government to increase the defense budget to the equivalent of at least 2% of gross domestic product, the same spending target for NATO alliance countries, a level much higher than the 1% of GDP rate capped for Japanese defense spending in years past. We remember that Japan has three major potential geopolitical flashpoints on its periphery, each of which could pull the world's number 3 economy into a military conflict with China. North Korea, the Senkaku Diaoyudao Island dispute in the East China Sea, and of course, Taiwan. Okay, that is today's episode of China Update. Thank you so much everybody for listening. I'll see you tomorrow.